Thank you, Francois. Good day, and thank you for joining us today. It's my pleasure to introduce you to Curate Investments, and more specifically, to the exceptional asset managers we've sought out from around the world to look after your clients' money. We've all experienced the explosion of choice in our daily lives. From streaming services to coffee orders, having options is seen as a good thing, but too many options can quickly become overwhelming. This challenge is magnified when it comes to investing globally. Did you know there are approximately 143,858 unit trusts globally? To put that into context, if you had 1 year to research all of them, you'd need to look at 394 funds per day. That's clearly not realistic, and your time is better spent with your clients, not buried in fund fact sheets. And that's where Curate comes in. We built Curate Investments on a belief that more isn't better, but better is better. Our manager selection process is designed to cut through the noise and focus on what really matters. Through global partnerships, we access exceptional teams who share our values and can deliver consistently for our clients. We don't just assess performance, we go beyond that. We assess the thinking behind the numbers, seeking managers with a clearly articulated investment philosophy. They need to demonstrate why they are unique in their approach and show that their processes are repeatable and risk-aware. We endeavor to meet the teams, test their conviction, and evaluate their risk management processes. Once selected, we build long-term partnerships with them, continually monitoring their performance, behavior, and alignment with client expectations. And of course, if things fundamentally change, we act, always in the best interest of our clients. During the session, we hope to demonstrate this selection process and take you on a journey around the world to meet our managers and share why we believe they stand out in a sea of options. Let's begin in Rotterdam, where we meet Jan de Koring from Robeco, one of Europe's largest quantitative asset managers.
My name is Jan de Koning. I'm a portfolio manager from Robeco and I live in the Netherlands. Robeco was founded 95 years ago, and one of our first directors said every investment decision should be research-driven. And that's still a key philosophy that we apply as of today for managing our quantitative portfolios.
The question we get asked often is, why quantitative investing? In essence, quantitative investing leverages data and algorithms to construct portfolios designed to deliver repeatable and consistent outcomes. The key to success in this form of investing, however, is deep research and continued innovation. That is why we partnered with Robeco to manage our quantitative portfolios, because as Jan explained in the video, every investment decision at Robeco is research-driven. And over 20 years ago, Robeco pioneered quantitative investing and have continued to lead by building portfolios driven by evidence and data signals. In terms of the Curate's quantitative fund range with Robeco, they manage our enhanced index funds. This is a form of quantitative investing. It is similar to passive investing in that it invests in an index. However, based on the data and algorithms, the approach goes one step further. Robeco actively over- or underweight stocks relative to the index using refined models that combine value, momentum, quality, sustainability, and even analyst signals into the approach. Now, you may be among the investors who value the benefits of passive investing, and rightfully so. Passive investing offers broad-based exposure, transparent benchmarks, and of course, lower costs. But how does it stack up compared to enhanced indexing? You still get those benefits, but when you deliberately over and underweight relative to the index, it also results in smarter stock selection, stronger return potential, and improved sustainability. But the proof is in the pudding. Robeco managed 2 strategies for Curate Investments, each with track records that have recently surpassed 5 years. The first is an enhanced indexing fund that aims to outperform developed markets. The graph illustrates the performance of the Curate Global Sustainable Equity Fund. It shows the peer group quartiles within the bar chart. The dark blue representing first quartile peer relative performance, and the light blue representing second quartile performance, etc. The yellow line tracks the performance of the Curate Global Sustainable Equity Fund, which has consistently delivered performance ranked within the first quartile of the peer group. Similarly, the mandate that aims to outperform emerging markets exposed to countries like China, Brazil, and India has performed in the top quartile relative to its peers. Another advantage of investing within the Curate Global Emerging Markets Equity Fund is that it is exposed to sectors including technology, consumer defensive, and energy, which are underrepresented on the JSE. The JSE obviously having a higher exposure to resources. Typically, South African portfolios are underweight emerging markets. And in fact, this year, emerging markets outperformed developed markets. And it's something that we should not continue to ignore, especially with the current geopolitical issues. Robeco has been all about the numbers and the signals, but now let's travel to Boston in the USA to talk about the BFNs. What does BFN mean? Well, simply put, we're talking about big flippin' numbers. Here are some stats. The generative AI market was worth $29 billion in 2022. Today, it's around $50 billion. That's a 55% increase in just 3 years. ChatGPT, for example, now attracts over 5 billion visits per week and has surpassed 1 billion users. The Magnificent Seven have committed $400 billion towards AI development, which is the equivalent of South Africa's GDP. And those numbers just reference tech, but there are other massive opportunities that are out there and still need to be uncovered in sectors such as healthcare, fintech, and e-commerce. Growth is happening, and it's happening fast. So we searched for a manager that is built to capture this kind of inflection, and we found Jennison Associates. Let's hear from Mark Baraboo, the portfolio manager of the Curate Global Growth Equity Fund, to learn more.
Hello, I'm Mark Baraboo from Jennison Associates, Managing Director and Head of Global Equity. We run a global growth fund for Curate. It's a very exciting product, we think. We like to target really innovative and disruptive businesses around the world for investing. These are game-changing companies. Using innovation, they bring huge advantages to consumers, whether it's meeting unmet need in the marketplace or delivering very exciting new products and services to their customers. It can also be companies that are targeting other businesses with big productivity enhancing applications, maybe developing the next generation of technology that we'll all utilize someday.
So essentially, what is the secret sauce within Jennison? Well, they have dedicated analysts to hunt for the next structural winners. That means not the player that will come second, only the companies that will be the best within their industry. These companies are obviously difficult to find, and there aren't many. Think of the Magnificent Seven. But over the last 15 years, Jennison have caught the development of the internet, mobile internet, cloud-based computing, and of course, generative AI. They also give you access to other sectors that we wouldn't get in South Africa, including healthcare, fintech, and e-commerce. So why have they done so? Well, because they don't hire analysts with the quote, value mentality. And once they have uncovered the next growth company, they will implement with high conviction, holding only 35 to 45 shares in the portfolio. They hold companies like Nvidia, Microsoft, Amazon, Netflix, Hermes, Ferrari, and Mercado Libre, a large online retailer in Brazil. All these companies offer something unique and lead to an undeniable consumer demand and competitive advantage. These are the kind of stocks that clients love to talk about owning. The beauty of this growth portfolio is that it will always be invested in companies on the cutting edge, companies of today and tomorrow, not of yesterday. But conviction cuts both ways, and having a strong sell discipline contributes significantly to performance. Jennison do not subscribe to a buy and hold approach, and one such example is Tesla. Tesla was a strong performer for the fund, but by mid-2023, rising EV competition, particularly from China, and unexpected price cuts to maintain market share signaled a shift. With oversupply outpacing demand and weakening fundamentals, the team decided to exit the position entirely, concluding that Tesla is no longer ranked among the top 35 global growth stocks to hold. As per the line chart, not holding Tesla contributed to returns within the portfolio, similarly to holding the share pre the sell decision. Despite Tesla being a big contributor towards the portfolio, every single position has to earn its position in the portfolio every day. And that also illustrates that they do not fall in love with the stock, regardless of its contribution. Now let's jet off to the English countryside to meet James Noodler from Evenlode Investments, manager of the Curate Global Quality Equity Fund.
I'm James Noodler, and I'm a portfolio manager with Evenlode Investment. I look for investments which are long duration and have, well, actually infinite duration, ideally, and which can generate attractive returns ahead of inflation for a very, very long period, where you don't have to worry about reinvestment risk, roll risk, anything like that, which can grow as an index on the broader world economy and ideally go a bit ahead of that. So that confines me, well, pushes me towards listed equities, which I think have got the longest durability out there among financial instruments. And then within equities, listed equities, it makes me concentrate on ones which have some sort of hard to replicate competitive advantage. It can be household names like a Colgate or a Diageo, or it'd be companies with more esoteric reasons for existence like an Experian or a Verisk or an Informa. But those sorts of companies have found through my career compelling as investments with a degree of valuation sensitivity built in as well. The single investment principle on which I would never compromise is the quality of the instrument. So it has to be an equity with durable pricing power, and that pricing power comes from that competitive advantage we talked about.
To summarize, Evenlode looks for high-quality businesses at sensible valuations and ensures there is a robust risk management process to ensure long-term compounding returns for shareholders. The majority of South African clients invested offshore have a significant exposure to quality already, given the focus on some of the larger management brands in South Africa. This is a great opportunity to truly provide a differentiated offering to your clients that will work well alongside your current managers. Let's unpack this approach with an example that we can all associate with quality. We all know what quality chocolate tastes like, and we sure all recognize this brand. In terms of quality, Lindt has exceptional brand equity. And as you will recall, in terms of what you paid for those gold bunnies this past Easter, they certainly have pricing power. And although the consumer may be under strain, Lindt has historically shown that a roughly 10% price increase has typically resulted in only about a 3% volume decline, still yielding around 7% growth. Also, they demonstrate the diligence to reinvest their capital. For example, they continue to invest in marketing during the pandemic, unlike their peers. A distinguishing feature of this manager is their valuation overlay, which sets them apart from their competitors. Evenlode were assessing Lindt since 2020 and used the increase in cocoa prices as an entry point into the quality company in April 2024. Never overpaying for quality companies with strong moats. Lindt is still held in the portfolio today, offering a great shareholder return resulting from 150 million Lindt bunnies sold per year. And essentially, if you were to line them up, that would be a line of Lindt bunnies from Switzerland, where they're made, all the way to Cape Town. Next up, we head to New York, to the manager of the Curate Global Value Equity Fund, focusing on only buying the cheapest 20% of the market. Yes, you heard correctly, only the cheapest 20%. Now, I'm sure you must be thinking, junk, value trap, cheap for a reason. But Lyrical have a different take. They search for the gems amid the junk. Why do they think that they can find these gems? Well, as per the chart, over the long term, the cheapest stocks have consistently delivered strong returns. Since 1974, investing in the lowest priced quintile of the MSCI World stocks, you would have outperformed by over 5.5% annually, in spite of the fundamentals. So when you do consider the fundamentals, Lyrical Asset Management have proven that deep value investing, or buying at the steepest discounts, does generate long-term alpha. Let's hear more from the founder and CIO, Andrew Wellington.
I'm Andrew Wellington. I'm the founder and chief investment officer of Lyrical Asset Management, and I live in New York. There's a lot of different ways to invest in the stock market. At Lyrical, we're value investors. You can think of us as we're the bargain hunters of the stock market. Some investors like to chase the latest trends or the hot new thing. We sift through the market and look for those stocks that have been ignored or been missed. And as a result, we can get really good businesses at really cheap prices. And value investing is a lot about what price you pay. You could take a great business. You could take the best business in the world. But if you overpay for it, you're gonna get a bad return. All of our investments have three specific traits. We summarize this with VQA. Those three traits are value, V, quality, Q, and analyzability, A.
Let's unpack their VQA investment discipline. Essentially, they're looking for stocks that are cheap, good, and simple. As we saw on the previous chart, there are high-quality businesses within the bargain bin. To avoid the pitfalls of value investing, businesses must be easy to value and simple to understand. Lyrical don't invest in companies like banks, which have unpredictable earnings. Think about the large FX trading desks of the international banks. And furthermore, they also avoid asset-intensive businesses like airlines. This results in an uncommon combination of deep value and growth. The Curate Global Value Equity Fund has a lower price-to-earnings ratio, yet because of their VQA approach, they uncover stocks with earnings higher than the MSCI World and MSCI World Value indices. Let's apply the Lyrical way in an example. On the slide, we show the long-term share price, earnings, and PE history of Ameriprise compared to the MSCI World Index. Let's look at the price. The stock was cheap in early 2011 when Lyrical entered the position and had a PE of 13 times relative to the 20 times earnings of the index. In terms of quality, it delivers an earnings growth rate of 3.5 times that of the index. And lastly, analyzability. Ameriprise is a financial advice business which has over 2 million clients in the US, and their cash flows are easy to understand and forecast. Trading at lower PE multiples with superior earnings meant that this gem contributed meaningfully to the portfolio. A great example of the VQA principle, and this can be applied to each of the stocks they hold. Bringing it all together, each of these active managers follows a distinctive investment style. value, quality, and growth. These styles perform differently through different market cycles, but what matters most is that our managers stay true to their core belief system. And when you look at their portfolios, there's remarkably little overlap, highlighting just how differentiated they are. For example, there is no surprise that our selected growth manager and our selected value manager have no stocks in common. There is only one stock overlapping the quality and value portfolio and 4 overlapping the quality and growth, given the strong competitive advantages of these companies. In conclusion, here is a summary of the Curate range of global equity funds available on the Momentum Wealth International platform. We believe these funds opens a world of opportunities for you and your clients. We created these funds based on how you, as financial advisors, construct your clients' portfolios. Whether you're seeking low-cost passive alternative strategies, high-conviction growth, deep value opportunities, quality compounders, or if the blend is your friend, our carefully selected managers combine the science and art of investing, each guided by a philosophy worth backing. And we've brought them to you, to South Africa, so you don't have to search the world of funds alone. For more information, please contact your investment consultant or your Curate fund specialist. Thank you for your time. We look forward to the journey ahead.